One of the questions we get often is, are personal injury settlements taxable? Meaning, do you have to pay taxes on the money that you get when you win a personal injury case? And so let's talk about it. So it really depends. The majority of personal injury settlements or verdicts are not taxable because the IRS does not consider them to be income, meaning it's not like you have a job and you get paid for the job and so that's your income. Instead, it's considered a reimbursement of sorts, meaning this is money you're getting back that was taken from you. So in a personal injury case, when you're injured, you lose essentially something. You lose your health, either permanently or for some period of time. You lose potentially the ability to work, either permanently or for a short period of time or for some period of time. And so when you get this money out of a personal injury settlement, it's not income. It's considered being reimbursed for something that you had lost and now you've regained. There is an exception to that though, which is if the personal injury settlement includes a confidentiality clause, which they often all do. But what happens is if you get a personal injury settlement and you agree to a confidentiality clause and there is no limit or no amount of money set in exchange for confidentiality, then the IRS gets to decide how much of your settlement is to reimburse you for the personal injuries and how much of that money is paying for confidentiality. The confidentiality portion is taxable, and so in essence, if you don't make sure that there is a line in there in the personal injury settlement that says, confidentiality is in exchange for $10 or $100 or whatever it is, then you may be in a situation where the IRS comes and tries to tax more of your personal injury settlement than what otherwise should be happening.